Saving money feels responsible. It feels safe. But here's the truth most people never want to hear. Saving alone will never make you wealthy. Not now, not ever. Why? Because the value of money itself changes over time. Take inflation. Back in the year 2000, $100 could buy you what now costs about $168 today. That means every single year, the cash sitting in your bank account quietly loses a little bit of its power. And here's the kicker. Even the best savings accounts often pay less than inflation. So while you feel like your savings are growing, in reality, they're shrinking in terms of what they can actually buy. It's like filling a bucket with water while there's a hole at the bottom. You're working hard to put more in, but it keeps leaking out. That's why saving on its own is a trap. And if you've ever wondered why you don't feel richer, even as your account balance slowly ticks up, that's exactly why. Now, let me make this real with a story. I always tell my parents that saving isn't enough. Their salaries have gone up over the years, sometimes more than they ever expected, but somehow they're still in the same place financially. And it's not always because they're spending on nicer things. A big part of it is that prices rise too. Groceries, bills, and everyday costs keep climbing. So even if your paycheck is higher, it often just keeps you treading water. That's the trap. And when I try to explain investing to them, they look at me like I'm explaining Wi-Fi to a cat. It's like I'm speaking science fiction. To them, investing is something only rich people do. And I get it. A lot of people still think that way. But the truth is, that mindset is exactly what keeps people stuck. If you only save, you'll always feel like you're working harder and harder just to stay in the same place. Now, none of this means saving is useless. Far from it. Savings have an important role, just not the one most people think. Saving isn't how you build wealth. It's how you build stability. Think of your savings as a safety net, not a ladder. They're there to catch you if something goes wrong. A sudden medical bill, a job loss, a broken car. Most experts suggest an emergency fund that covers at least 3 to 6 months of expenses. That's your foundation. Savings are also perfect for short-term goals, like a vacation, a new laptop, or a down payment you'll need in a year or two. In those cases, you don't want the money at risk in the market. But beyond that, saving every extra dollar and letting it sit there, that's not a plan for growth. It's a plan for standing still. And standing still, financially, is just another way of slowly falling behind. If saving is your safety net, investing is your engine. It's how ordinary people, not just the rich, actually build wealth over time. And investing doesn't have to be complicated. At its core, it means putting your money into assets that grow faster than inflation. Things like stocks, bonds, or index funds that track the market. The real magic of investing isn't luck or timing. It's compounding. That's when your returns start earning returns of their own. For example, if you invest just $50 a month and earn an average of 7% a year, you'd have over $60,000 after 30 years. Double that to $100 a month, and it grows to more than $120,000. It's not about being rich before you start. It's about starting so you can become rich. Think of every dollar you invest as a tiny employee. The sooner you hire them, the harder and longer they'll work for you. And this is why starting early matters so much. Imagine 3 people. Mary starts investing $200 a month at 20 and stops at 30. Sue waits until she's 30 and invests the same amount until she's 60. Brian waits until 40 and invests until 60. Even though Mary invested far less money overall, by retirement, she often ends up with more than Sue or Brian, all because she started earlier and gave compounding more time to work. That's the quiet power of time in the market. It's not about doing more. It's about starting sooner. So why does any of this matter? Because if you rely on saving alone, Your money is quietly losing value every single year. Inflation eats away at its power, rising costs keep you stuck, and the dream of financial freedom stays just that, a dream. But when you invest, even small amounts can grow into something meaningful. You give your money a job. You make it work while you sleep. And over time, those little decisions, $20 here, $50 there, can change the entire trajectory of your life. And here's the part most people don't realize. Once you've built assets, whether it's stocks, bonds, real estate, or index funds, they don't just grow quietly in the background. They can give you options. You can reinvest the returns, use dividends to buy more, or even leverage those assets to unlock bigger opportunities down the line. That's when money stops being just something you earn and starts becoming something that works for you. This isn't about chasing quick wins or getting rich overnight. It's about building a foundation that gets stronger year after year. Saving gives you stability, but investing gives you freedom. One keeps you safe, the other moves you forward. So if you're watching this and thinking, it's too late for me, or I don't have enough to start, stop. The best time to start was yesterday. The second best time is right now. Because every day you wait is a day your money isn't working for you. And the sooner you take that first step, the sooner you stop trading time for money and start letting money buy you time. I'm the Uneducated Economist. Thanks for watching, and I'll see you in the next one.